it, we'll sell a bit because it's getting expensive, but we do add on from time to time as well. Okay, so finally, we talk about performance. And if you look at year to date, it's up almost 9% for the Sing Dollar share class. This is available to you. So you bought this since the beginning of the year, you have already been up about 9%. So it's not the kind of strategy that shoots the lights out, give you 20, 30%. No. What this does is gives you, as I mentioned earlier, minimize the risk, gives you a position in your portfolio that helps you to preserve your purchasing power, give you a very attractive level of income. And you can see over time, it has managed to deliver a very steady returns. In 2022, for example, if you look at the table at the bottom, 2022 was a year post-pandemic. Everyone was traveling, very happy. We got to travel again. Pandemic looked like it was behind us, but then there was a market that was doing very badly. Both equities and fixed income were down more than 15% globally, right, in 2022. So the global MSCI World, the global ag was down more than 15%, and this actually outperformed. It was only minus 7.6. Yeah, it's still a loss, but it proves that when markets are panicking, the strategy actually underperforms lesser. You can see over time, since 2015, you bought into this strategy, you have made almost close to 40% cumulative returns. And this year, of course, it's done well. And we think we'll continue to do well, which is why recently we received a lot of interest in this strategy. Because past few years, it's all been growth stocks, tech stocks, but now investors are gravitating towards more less growthy and high quality portfolios. And this so far, in terms of Morningstar, is the top decile, that means top 10% within this peer group. And that has proven to be the right call for a lot of investors since the beginning of this year. In terms of performance attribution, so what we do is that we talk about this chart because we want to share this chart because it talks about how all these individual asset classes, perform, where's the alpha coming from, where's my returns coming from. And you can see on the top left-hand side, all these asset classes and sectors have done well. Very little negative performance. You can see that one of the negative performance is cash. So any investor holding cash will underperform this strategy, of course. And you can see on the right-hand side, just the contributors, mostly coming from consumer staples, discretionary, as well as healthcare and banking and finance. Okay, before I show what kind of share classes that are available to you to invest into the First Eagle Upwardly Income Builder, I just want to share some key takeaways here. One is the firm has been around for a long time. They have, leadership in value and gold investing. They have been around since 1864. None of us were around since then. So they're highly focused and strongly aligned. Philosophy as well, as I mentioned earlier, we've got flexibility and discipline. One cannot function without the other. It's very complementary. And we think that there is a time-tested approach, and at least we will be helping to, maintain a high level of income for investors, but at the same time preserving purchasing power and also minimizing risk. Because no point you pay a very high dividend, as I mentioned, and you get a very high return, but then your risk level, your volatility is also very high. We know some of that. I'm quite sure you've encountered, investments will provide, 10, 20% return, but then it's so volatile, and nothing wrong with that. If anyone makes money from that, by all means, but this strategy is supposed to provide a very good nesting egg for investors who, preserve that purchasing power over time. So you don't have to look at it every day. You just put this maybe for retirement, to reach your financial goals, and then you have a bit of play money for more volatile stuff. That's the kind of investment this can be used for a lot of our investors. And then the last part is more of results. And that came from a lot of high diversification and downside protection. And remember, it's similar to what I mentioned for the first point, is gold investing. Gold investing is not just buy, don't think about it. You have to trade it a little bit and use it for hedging, and that's when it's able to help deliver the results within the portfolio. It uses it as a hedge because it doesn't pay an income. Gold doesn't pay an income. But at the same time, it provides that the absolute return which will thrive, during volatile periods of time. Okay, I talk a lot already, so keep in mind your questions. Happy to take them shortly, but these are all the share classes available. You can see with the tables on the right-hand side, there is a performance fee. The performance fee means that if this strategy outperforms the SOFR, which is the overnight rate, by 330 basis points. So 330 basis points by the SOFR, which is 4.3% right now. The hurdle rate is about 7.6. So it is daily accrued. If this strategy outperforms that benchmark, that hurdle rate, then what will happen is that you will pay a performance fee, which is 15% of the outperformance. Not much if you think about it. But if it doesn't, then you don't have to pay because your management fee is at 1.6%. So it's very good. A lot of investors tend to like this because I buy into this strategy, it has to outperform. If it doesn't outperform, I don't pay the performance fee. If it doesn't outperform, I'm still getting about 7%, which is below the hurdle rate. I'm pretty happy with that. So I think that's the way to think about this, for the performance fee. If you buy right now, of course, you can see that the record date is 28th of August, and the payment date is 9th of September. So maybe after settlement within whatever platform, Philips platform that you buy is, it could be 10 or 11, right? And finally, I just end off with the dividend distribution. You can see with the table at the bottom, the annualized yield is about 5+%. Okay, it's not the highest, but like I mentioned, it's about total return. We don't aim to pay a very high dividend that is not sustainable, and then your NAV is moving down. What we're going to pay is analyze yield, but also preserve your purchasing power and also minimizing the risk. So you must think of those three elements. It's not just analyze yield because the price can move up as well. And so if you talk about since the beginning of this year, by estimates, if you look at the annualized yield is about 2.5 because half a year. Actually, the NAV has moved up almost close to about 7%, right? So your total return is about 9% year to date, 2+% from dividend, about 7+% from the NAV. So you're getting still more returns from the actual price movement, the appreciation of the underlying assets rather than just the dividend yield. So with that, I end my presentation. I thank you for your time and attention. I hand it back to Susan.
Thank you, Dennis, for the presentation. So now, if you guys have any questions, you can just put in the questions now. We will try to address your, concerns. Actually, I have a question. That is it a good time to, at this moment with an interest rate cut that we are seeing going forward, so is it a good time to invest into your fund at this point? What is the advantage of putting into a defensive portfolio? Like the one, this is our topic for today.
Thanks, Susan, for asking that question. I think it's very valid because, investors are very aware that the market is changing, right? And that is why I shared this chart earlier on about a 10-year Treasury yield. So, it has moved up, yes. But at the same time, there's a lot of liquidity drain. Interest rates may move down as well. But if you look at the interest rates right now, because of a lot of inflation that has seeped into the economy, our view is that it will go down, but not a lot. That means the lower for longer kind of zero interest rate environment will not come. What does that mean for the portfolio at least? Is that as long as we stay at the current levels, whether it's 1, 2, 3 rate cuts, it's still pretty high by what we saw from 2009 to 2022, for example, almost more than 10 years. So that means that for investors itself, they want to be focusing more on quality stocks because of liquidity drain. If you have high interest rates, more investors are moving to cash. Markets are actually, seeing a bit of liquidity drain from stocks, fixed income, and that's when you have, the kind of quality stocks are starting to play out a little bit better and outperform growth stocks. So overall, even if interest rates move down, which is a good thing, I think that will keep stocks afloat. You must imagine that it is still pretty high by historical standards. So I hope that answers your question, Susan.
So it means that this portfolio can change actually either overweight in equities or overweight in bonds, depending on the market condition. Is that right?
Yes.
This is to sustain the income payable to the investors.
So that's right.
Okay. So in this case, right, if customer is looking for long-term growth of your cash or your SRS fund, this will be a good option.
Yes, that's right.
Okay. And
Yeah.
given that it is actually a US dollar uh, denominated fund, and over at Philip, we offer the Sing Dollar hedge class. So it offers a good hedging for the investors in terms of the currency exposure in case the dollar is going to cut further, as well as the interest rate is coming down as well. So what is the uh, it's good point for the customers to stay invested. You know, what is the good time frame that they actually stay invested for this fund?
Okay, the time frame really depends on the risk profile as well as the time horizon for the investors. You know, they have different financial goals to meet. Usually for this investment is if time period can you if you hold within 1 year, nobody is going to ask you to going to stop you from selling if you already made 9%. But typically, to really see results, it has to be about 3 to 5 years, because this will allow them to really see the overall returns of the portfolio to grow, and they want to receive the dividend as well over time, because at the end of the day, this strategy is not something that you buy today and then after 1 year you sell, making 20%. If it does, yeah, you can sell, but because of the way it allocates to the portfolio, what it does is to preserve your capital over the medium to long term. And for any investor, when they buy into this strategy, is to complement what they have in the portfolio, to plan for their retirement, plan for their financial goal, whether it's the kids going to university, so on and so forth. By the end of the day, is not supposed to be something that's very tactical. It's more of a call. So for any investor, they have a portfolio. They have core, which they want to you know basically keep for the long term. And then they have tactical strategies. They can buy Bitcoin, they can buy stocks that they like, they can buy, more tactical, what we call satellite or tactical. So they can have, 10 to 20% allocation to that. Nothing wrong. But for this kind of strategy, it's supposed to be a core in the investor's portfolio. So you hold it, you get paid, to wait, and then when the investment is, reaches the end of the time horizon, and you have reached your investment financial goal, and then you can just redeem it. So it basically is a medium to long term investment.
Okay, thank you, Dennis. I think there's some questions that customers are asking. What
Sure.
is the outlook for Europe equities for the next 3 years?
Okay, Europe is a very interesting, macro environment right now, and we have received a lot of interest from institutional investors since the beginning of this year because of what's happening in US. So post Liberation Day, when Donald Trump came out of the White House, and then it started to show this big chart where you have all the tariff increase all over the world. That shocked the market a little bit. But if you look at what happened, there was a sharp correction, and then markets recovered. Right, very short span of time. Uh, I think that will continue to spook the markets. That was a fundamental paradigm shift. And you can see that tariff rhetoric and communication continue. It's Donald Trump's way of closing deals. If you read his books, you will understand that that's how he tries to use leverage to win a better position for himself and the country, to win deals. And what will happen is that we expect more diversification. So the US exposure over the past 10 years has been very good. But investors should think about, how to get diversified out, because a lot of things are going to fundamentally change. And diversification is more important now than ever so before. So to the point about Europe, we like it now, because, we've been increasing the allocation to non US equities, as I'm showing in this chart, especially in Europe and Southeast Asia, because there are a lot of good companies in this region with strong fundamentals and attractive valuations. And that's why we continue to like it. So I mentioned earlier about the company Richmond. It's actually a European company, and it's luxury goods, and yes, a lot of artisanal constraints that investors cannot just reproduce anywhere, right? Whether it's Cartier, Chloe, or Van Cleef Arpels, Dunhill, they've been around for a long time. Yeah, they may not be as popular as before, some of them, but at the end of the day, you can't just come up with a new brand and say that this is the new Dunhill or new Cartier or VCA. And that's where the uniqueness come from. A lot of good companies in Europe are starting to get better, stronger, and you can see that across the market as well. And with the ECB looking to potentially moderate monetary policy, that means cut interest rates, it could be good for the stock market as well. So we're monitoring this very closely, but at the same time, if I may just re-show the chart about a portfolio allocation, you will see that our allocation to US is a bit lesser than before, right? As I mentioned earlier, it's about 42.2%. It used to be slightly higher, close to about 50, even 60 before. Now it's been reduced. And the Europe allocation, as you can see, our conviction there is about close to about 21%. So in short, we like Europe.
Okay, that's great. I think Europe is a good investment considering the watches that you mentioned, Richmond Company. I think the price of all the expensive watches is very high now. When my last shopping at Cortina Watch Center, I can see that the price every month it changes. I do totally agree. So, and there's
Yeah.
another question that the customer is asking. The
Yeah.
year-to-date performance of 9% is actually based on the US dollar or Sing dollar hedge.
The US, this is Sing dollar, so it's
Uh,
hedge, right? So the thing is
uh,
that we do not get any returns from the any currency appreciation.
mm,
There is a currency hedge of cost of around 2%. So
mm.
if you have a US dollar hedge, it's slightly higher than this absolute return. So there's no currency player. If you look at the return we have here, it's hedged in Sing dollar. So no currency player. The portfolio doesn't do that. It's all hedged back to the currency. So when you invest into this, you're not taking any currency positions or exposure.
So the 9% is based on the performance of the Sing dollar that we invested.
Yes.
Okay, thank you. Yes. So I hope I address your answer. Okay. Okay, so there's one more question that's being asked. Which Asian or countries exposure your fund is looking for future growth? Uh, okay, maybe Dennis can address this, but I think it will be good to put into the to the Amundi fund to stay invested, and then so that you can take advantage of their expertise in looking for the fund management, right? Okay, maybe Dennis want to address this question.
Yeah.
Future growth in the Asian region.
I mean, Asia is something that we are starting to get more confident on. Again, I bring back to this positioning chart about 11.8%. And even for our allocation, where obviously we sell US, we have to buy something, and Southeast Asia and Europe are one. We used to like companies like Haw Villa. We used to, right now we also have exposure to Noble, but we sold off a little bit. Southeast Asia is very dynamic and very young in terms of demographics. That is a lot of investors are looking at a lot more now than ever before. And we think the consumer spending will continue to improve. So, if we were to look at Southeast Asia or even Asia, we got to be careful. So, if Japan, we can still buy, but you buy companies that are maybe consumer staples. In Southeast Asia, consumer discretionary. So at the end of the day, it really depends on the valuations, and we think Asia is a very good ground to be looking for good stocks and good positions, whether it's fixed income or even equities.
Okay, yeah. So I think we have addressed most of customers' question. So I think I understand from Joey is that the year-to-date performance of the fund has actually increased. It's actually now at 11.5%. Is that right?
Yes.
Mm. So the current performance is actually much better than what we have presented in this slide. It's actually at 11.5%. So it's actually a good time for customers to stay invested. So if you guys are interested in this one, you can always visit me at my office at the Raffles Place branch. And every month we do a presentation either in webinar or face-to-face seminar at the office to the customers. So if you'd like to have touch base with this investment, you can always, follow us and let us to know what are the seminars or webinars that we are hosting. And you can also upgrade your portfolio as well.
Thanks, Susan, and thanks everybody again for taking the time. I'm very glad you're using this, Philips platform. It's been around for a long time, as Susan mentioned earlier. It's the first platform to, conduct online trading. Has grown so much to so many different products on the platform. And of course, unit trust, buying the first income builder is one of them. Keep the questions coming in. You can always channel, if you think of anything else, you can channel any additional questions to Susan. We'll be happy to address them. But of course, I want to thank you for spending your lunchtime with us. And thanks, Susan, for organizing this as well. Thank you, everybody.
Thank you, everyone. Okay,
have a nice
thank you,
day.
Dennis. Yes, and
See you.
thank you, everybody, for joining us. And I hope you
Okay.
enjoyed this session. Okay, please stay tuned. We'll be having other sessions next month in September. So if we can also invite Dennis and his company and his team to come back to us again, probably in the last quarter of the year, to update us what's happening for the unmulti fund. Probably we can reach a 15% kind of return. That would be fantastic, right? Yeah.
Thank you, Susan.
Okay.
Thanks, everybody.
Okay,
Have a nice
thank you,
day.
everyone.
See you.
Have a good day. Okay,
Thank
thank you
you.
so much.
Bye.
Bye-bye. Bye.